Hi, this is Randy Finney with Right Side of the Chart, and this is a midday market update for Friday, March 29th, 2019. Wanted to do this one before the markets close today. If we get anything big, which I don't expect by the end of the day, I'll do another update. But as of now, same old, same old. We're not going to spend a lot of time on the weekly or the daily charts because nothing's going on there. We are once again, to recap, on the fifth, about to wrap up the fifth consecutive week of the S&P 500 or the SPY, testing that key 282-ish level. You can see there it is, 1, 2, 3, 4 candles. Last week's we had that interweek big move following the Fed pop. That was faded, and again, unless anything huge happened, and I really can't see that with just 4 hours of trading left to go. No matter what we do, whether we park a hair below or a hair above or a hair below that level, it's still basically on it. We need to put that level in the rearview mirror clearly. So again, bulls want to see the highs from last week, last Thursday, taken out, and bears want to see these two candles right here. That's really the bottom of the range. I do have some levels I'm focused on a little tighter that might give us an earlier head start on things, and that would be on the daily chart of SPY, 277.50. Again, that's a level I've highlighted the last week or so here. It seems to have contained all pullbacks since we entered this sideways grind, except these 2 days here. Actually, we closed back above it there. So before I was saying 3 candles. So really that green candle closed the day back above. So we had a brief spike there. So if you exclude those 2 candles that briefly whipped down and back up, that's done a great job. So again, that would be a potential early sell signal on the markets if we can finally get below there, especially a solid daily close. Remember, this is the one guarantee you have lately in the markets, or it's whipsaw city. Basically, it's the algos playing ping pong with each other. The algos are the high frequency trading programs are firing off buy and sell signals. They're having a field day on intraday rips and dips, but at the end of the day, the market's going nowhere. So that's the levels we want to watch, and let's zoom down to the 60-minute charts because we do have some interesting developments. I'll loop back to the 60 minutes. Let me just get to this 15. I posted this today on QQQ. We have, this chart might look busy to you, but let's just focus on a couple things here. The recent divergent high right here, and this is the same pattern I was showing on the 60-minute chart. Sort of almost an ascending broadening wedge type pattern, but this is our divergence line. Put in divergence, broke down, back tested, and then had a pretty impulsive move down. Came up, back tested it again, rejection again. So that is those were the bearish developments that we had. And by the way, that was on Thursday's pop after the FOMC meeting, and then the subsequent fade the next day. So what's happened since then? I've been highlighting this wedge recently. We have a downtrend line, or had a downtrend line on QQQ, and divergent low, and that takes the shape of a nice clean bullish falling wedge. So what I had said is I expected, if equal odds whether the wedge would break out or not, and if it did, my thoughts were and still are that it will fail to play out to its expected or measured target. What do I mean by that? This line right here. To take the measured move of a falling wedge pattern, there's other formulas out there, but I use one of the simple, and I think it's most effective. Over the years, you'd be amazed how many times these play out. And that is to take the widest part of the wedge, which I've done here, and then add that to where the wedge pattern breaks out. So right here we had an attempted breakout, a few 60-minute spikes, but nothing that really took. That was a failed breakout attempt there. And then yesterday, that was yesterday, but then later in the day, we limped above it. A very, what I call, non-impulsive breakout. You want to see a breakout on impulsive buying pressure, a lot of upside movement afterwards, and especially on increased volume. And that's about exactly what we didn't see. This is why you don't take low volume breakouts. Now, however, it played out. It played out in the form of a gap up today. And so that's where we're at right now. And again, this would be our measured target, which would take us right about to that high back from last Thursday. Now, the thing is, anything's possible, and we'll watch this. What I can tell you, I can't guarantee I'll be right, but I can tell you where I think the key levels to watch are, and that is R1 right here, about 179.72, meaning resistance 1. Why is that a level? Well, we have a gap right here, number 1. We have a reaction here, several reactions here, reaction there, reactions there. So you have price plus gap resistance. So that's a pretty decent level right there. And we popped it today at the open. We had a little follow through after the gap up, and then we reversed. So far we've been smacked down there on two different attempts today. 1, 2. Here, I'll zoom in for you. That's that level. Now it also comes in, again, busy looking chart, but this line here is the measurement of the Fibonacci retracement levels from the high right here, last Thursday's high, down to the recent low. So that line spans that point, and you can see to the left here, it's a perfect overlap. This is the 50% Fibonacci retracement, and all the better when you're trading if you can line up price resistance with other resistance levels such as trend line or Fibonacci retracement levels. It just makes it that much more solid. For many reasons. There are some traders that trade exclusively off fib, so they might not even see my, the same lines I see, resistance levels, and they may be looking to short a 50% retracement on this move down, so they may have stepped in there. Now again, resistance is resistance until unless broken, and why I think this will cap today's rally. If it doesn't, it's bullish if taken out. So if they can pop that 179.72 level with conviction, especially a solid 60-minute or 2 60-minute candles closes above. Let me say this too on to that point. It's almost noon as I'm doing this video. There's 4 hours left in the trading session. Be skeptical of late week. First of all, be skeptical of late day breakouts. More so, late week breakouts. You're going to head into the close here. So what happens is you have your day traders always close their positions out before the end of the day. That's by nature a day trader. It's in and out same day. And then you'll have some active swing traders that say, you know what, it's Friday. I'm not going to take the extra 2 days of overnight risk, so I'm going to close out. So in other words, take it with a grain of salt if we do get a breakout. Even if we get a failure there, we'll just have to see what happens next week. But those are the levels to watch. Next one, if we do pop 179.72 plus that 50% fib with conviction, then you have that 61.8 fib just below this price resistance level at about 180.70 or so. And that's that previous reaction high right there, couple reaction lows right there, and a reaction high there. So this is we'll call it my bounce target zone. Bears want to see us stay below that level. Bulls want to see that get taken out the top of that level. If it gets taken out, this is not the all-time highs on QQQ. It's that recent high from last week. But I can tell you, as I've been saying on the daily charts, bullish if that goes. My focus on the daily charts recently, although the other levels I just gave you, but I've also mentioned in the last several sessions, this is the battleground to me. These two candles. That was big green candle after the Fed meeting. Bears smacked it down the next day, and so far we're trading at the bottom end of the range. We haven't given it up, so I think this will be a tell whether the market, and you want to look at all the indexes, QQQ, SPY, maybe even the small mid cap, but more so the large caps. They lead the market. So that would be bullish. A break, especially a solid close above that level, were a definitive break and close. Not these little intraday pops and we close back up right on that level. We've been flirting with the bottom of that range, and we're still much closer to the bottom of the range. So despite what's going on today, a 0.5% lift in the QQQ, it means very little to me. It just tells me that we're still in that recent trading range, and more so, remember, QQQ is not a diversified index. It is an index, but it's more of a tech-heavy, top-weighted index. This is the broad market, and or the stock market, we'll call it. And this is the what the market's been doing, is moving sideways for a while. So, all right. So back to levels to watch. Just gave you the 15-minute chart. Yeah, we were looking at the 15-minute chart of QQQ, so I gave you some levels to watch there, and those short-term developments. Those divergences were the catalyst. But I've said this recently. I can't remember if it was in the public videos or on the member-only stuff. divergences or any bullish or bearish developments, you have to pay attention to as to what time frame and give them a higher or lower weighting. In other words, what happens on the daily charts, the developments there, the support resistance levels there are much more significant than what happens on the 60-minute and 15-minute charts. 60-minute charts take precedence or priority over the 15-minute charts. Weekly charts, and those levels and the developments you see there, although you need to wait till a week for Friday, end of week, Friday close to, finalize the candlesticks on a weekly chart, but they do have more significance than what goes on the daily chart. So when in doubt, and you will get that at almost all points in time, meaning conflicting analysis, certain bearish developments on one time frame, bullish developments on another, and can cause a deer in the headlights syndrome, paralysis by analysis. But again, that's how I work through it. And at the end of the day, if there's too much conflicting evidence, if I can't make a clearly bullish or bearish case, then stand aside. Trading can be tough enough. Don't try to force trades. But again, don't put too much weighting on a 5-minute, 15-minute chart if you're trading off of right now, if you're focused on, and this has been and remains my focus for a while. Those are pretty much my go-to swing trading time frames are the 60-minute, daily, and weekly charts. But I'll take a look at everything, and that's where the 15-minute chart on QQQ, indicated here we had that divergent low you can see in the wedge breakout. So let's just see if it plays out to its measured target or if it falls shy, because if it falls shy, it gives us a little character of the market. You get a 15-minute bullish falling wedge back in 2016, 2017. That thing was going to take you to new highs. If the trend is starting to turn in the market, the tide is finally shifting, then you'll start to see bullish chart patterns tend to play out, either not play out at all or play out well below their measured target like this. So, all right, enough on that. Let's go look at the 60-minute charts and wrap this up. Okay, this is the QQQ 60-minute. Let's zoom in a little tighter. We don't need to see everything that's happened back there. Most recently, let me pull that down. There's that broadening wedge-ish type pattern. It's not perfect broadening wedge, but most importantly, you have your divergence line up top, and then your uptrend line down below. Tighten that up a little bit, and again, same story. We had the recent breakdown, back test, and we're still below it right now. And so we have this little almost double bottom right there, some minor support. In fact, it comes all the way through here. There's some reactions. So we really need to undercut those recent lows. What I just showed you on the 15-minute chart, you'd really have to hone in here tight. That was that negative or positive divergence there, and you can even see it. It shows through on the 60-minute chart as well. Not as clean as it is on that 15-minute chart. That's why I showed you that one. What else stands out to me? Trend indicator, the old tried and true 9 EMA tells you that the trend is bearish. That was coming into the December lows, by the way. That goes to the left of the chart here. Bearish when the signal line, the white dotted line here, is below the zero line, and bullish when it's above. So most of the time it's told you the trend was bullish there. We've had a couple whipsaw signals. It's not perfect. There is not any one perfect indicator. If there was, and I knew about it, I would not be talking to you. That would be my little secret indicator. But I share what I have. Look, guys, some of this stuff works great at times, and sometimes it doesn't. That's the other thing about using this 9 EMA. Recognize which securities and which indexes it works well on and which ones it doesn't. And even if it's working, if I have a trend indicator that works great on a stock or sector for months or years on end, and then all of a sudden it stops working, you got to recognize that. Sometimes conditions in the market or a stock or a security change. But overall, on balance, this one does a great job. I talk about it a lot. I'm sure you've seen it. And so there it is. It crossed down below right here at this point, right around the time we back tested, or just before, I guess after that breakdown. And it said that the trend right now on QQQ, and this is this is a good trend trading time frame. It's saying that trend indicator is still bearish. The white line is still below the zero line for now, and I pointed that out as well here the other day. That arrow was on there. We back tested and we failed, and that was right about here or so, and we had another leg down. So let's just park that one in your head and let's look at the next one. SPY, S&P 500 ETF. And I can get this chart here. That we had divergent high. We had this uptrend line right here. Let's see. We had a breakdown, back test, back test, back test. That's the thing about back tests. Sometimes you back test for a while. Sometimes you regain a trend line. There's no guarantee a back test will eventually, fail or roll over. But this one did. It rolled over. You can see my little micro levels, we'll call them here on the 60-minute chart of SPY. Resistance, any line above current prices obviously is resistance. Any line below is support. This support level 280.50 or so has now been sliced through quite a bit. We had some reactions there before, and this little shelf right here of support that gave way. Then we gapped above it, so it was still active there, but we've sliced through it a little bit. But still worth watching. More importantly is these recent lows right here around 277.67. Quite a bit of reactions around there as well. And then if that level goes, this. And this, again, as I had said recently on the daily chart, a move below those lows from early March in both QQQ and SPY should, if it happens, in my opinion, open up some pretty impulsive selling if we get down to those levels. Not complete waterfall selling. I don't see that until we get down on those, the levels I've highlighted in recent videos on the daily chart. Here, I'll show you that. This is my, no, wrong time period. What's going on here? There we go. These levels here, they're color coded. Yellow is just caution. This is my minimum target, caution. Orange is even, a little stronger caution. That breaks. Red is you don't want to be long kind of thing. If that level goes, you want to be short, in my opinion. Okay, and back to that SPY 60-minute chart that I just jumped away from for a second. Again, here you go. We had a little, period there where it said that near-term trend was bearish, and so far we crossed right here. And the 9 EMA or signal line is now back testing. That's what that little arrow. So it's kind of a pretty important level for bulls and bears in the micro term. Remember, I'm doing these videos. If you're a trend trader or an investor, don't be overly concerned with what's going on. You can stop the video when I start out on those weekly and daily charts, and those are the levels to watch. Anything else in between is noise, but as active traders, we're watching these levels for clues, because you break support, it opens the door for the, a move down to the next support. If you break that, then that's much more significant. As of now, this is just that game of ping pong the algos are playing with each other, running it up and down intraday, having fun with the retail traders, blowing their stops out and doing whatever they do. And there's active traders too. You can game these levels. That's why I'm sharing these levels with you. This is resistance, as is QQQ, that level I just showed you. That was an objective level to short. We've had 2 shorting ops. I had to run out for an appointment this morning. A couple appointments it turned out to be. But I mentioned that when I got back that, let's see, on that 15-minute chart of QQQ, there it is. That, nope, where'd it go? There it is. Okay, lost my boards for a second. I had a lot of different drawing boards here. Right there, we were right there. Said that's, I gave my preferred scenario that we would reverse from that level, and we hit it again. So there's 2 potential shorting ops. And look, here's the thing: if it gets taken out, and I'm speaking now towards an active trader. Now it is Friday. We've already had the second tag. We had one in the morning. But if you short there as a swing or a day trade, you can have a relatively tight stop above. Maybe wait for a 60-minute close. And you can either day trade on the pullbacks off those levels, or you can, add or initiate short exposure with a stop not far above. So look, worst case scenario, you get taken out for a half a point, three-quarter point loss. You could even 1% loss. And, the downside potential, the ultimate potential is well over 20-25% if we break down from this recent range. But even just a swing trade within this grind that we've been in, come on back down here to that top of the support zone, that's a very favorable risk reward ratio. That much downside, whatever it is in points, you guys can measure that out, about the 3.5 point drop for about a half a point upside at 180 to 150, assuming your stop is hit. Okay. All right, so that was SPY, QQQ, we looked at the 15 and 60-minute charts. 60-minute chart of MDY. Remember, large caps, although they make up the bulk of the stock market as far as capitalization goes, you do have your mid-cap stocks. There's MDY, divergent high. It's not drawn out here. I'll add those lines for you. You know, we had the negative divergence at the highs, and we've been correcting since, and they've been mid caps and small caps have been in a downtrend now since February. You can see that it's not a violent downtrend because the broad market's moving sideways. Remember, the small and mid cap stocks, they can move the other direction, but for the most part they will go with the overall tide of the, you know, the large caps. So what happens, the large caps have been trading sideways mostly, where the small and mids have been going down. But we did have, as you can see here, positive divergence right now on the 60-minute chart. Here, we'll zoom in a little bit. There's your bullish divergence. And right now, here's we ran into downtrend line resistance with price resistance just above. If you're an MDY trader, that's the mid-cap ETF, called about 341.30. So these are the levels the bulls want to see taken out, both the downtrend line and that. Whereas shorts, or those looking to short, or even flexible traders, you know, short at the resistance, or buy a breakout cover, or buy a breakout above. But keep in mind, you want to watch what's going on SPY and QQQ and IWM if you're only trading MDY, because if you take a breakout here at the same time SPY and QQQ fail at their comparable resistance levels or break support, then I promise you that breakout's not going very far. The large caps would drag down the mid caps with it. So you need to take that more of a, like a holistic approach, if you will, to trading, by watching things that you're not even trading that will affect where the thing that you are trading goes, if that makes sense. So there's MDY, there's that positive divergence. It's popped above the zero line with that trend indicator. PPO is curling over, so just one to watch. And then finally, a lot of people like the small caps. Same story. I've mentioned this recently as well. 60-minute chart also had divergence, positive divergence. There it is, that divergent low, and following a much larger divergent high. So again, same story I've been saying for a while. I think we're at a very pretty important and potential inflection point, but at least a key point in the markets where we are on the weekly and daily charts of the large caps, what's gone on in the small caps and mid caps recently, and more importantly, if the tide is starting to turn, then what you will see is bullish chart patterns like this. You give me a 60-minute positive divergence on a 60-minute chart and a bullish trend, I'll take that all day long, because that usually leads to the next leg to new highs. However, if this fails to play out, and by playing out, number one, you need to break out, and number two, you break out after a nice, you know, that's a pretty good size divergent low on the 60-minute chart. That's usually good for a 5, 8, 10 or percent plus rally that could last for several weeks or more. But yet if it fails to materialize, because we haven't even broken out yet, we've reversed off the divergent low, but not very impulsively. So if we fail to break out, or break out and then reverse, don't go very far, then that is going to be pretty bearish. It just shows you that you know, just like bearish divergences and chart patterns don't work well in a strong uptrend or a bull market, if these bullish divergences and developments here don't pan out or play out as they should, then it shows you that you know, we're probably in the early stages of a new downtrend here in the market. So until then, it's still anybody's game, and that's where I'll leave it right here. You know, bigger picture, if I can get the right tool. Let's take all the lines off here. I know we're looking at the small caps, but just like the large caps, if you really step back and look, this is February right here, the end of January. There it is. So the market has gone nowhere. We're back to where we were in the beginning of February right now. We just recently hit that in the small caps. And so the bigger picture is this. It's nobody's, it's still anybody's game, but nobody's won in the last few months, bulls and bears. They've just gone back and forth. You know, we are stair-stepping a little bit lower on IWM, but again, that doesn't matter where IWM goes as much as this one here, SPY. And there it is. So, you know, this one is almost more of a stair stepping up, while the small caps go down. We could look at it this way. Certainly can't say that's a downtrend yet, but the bigger picture again is that more of that trading range. I may have been a little bit liberal with the box there to the upside. So the way I had it drawn on the daily chart, if you recall, is exclude that brief spike right there. No, that wasn't it. Right here, and just say this range right about here. I actually come in a little tighter. So let's see how this range is resolved here. That was a little brief whipsaw signal below it. And again, no matter what happens today, I don't think we're going to have any good clues to where the market's headed next week. So we'll pick it up there. This has been Randy Finney with the right side of the chart. I hope you enjoyed it.